The financial world is often painted as a realm of endless opportunity where clever investors multiply their wealth simply by being smarter than the rest. But beneath the glossy surface of modern investing lies a far more intricate story, one where the small print, the hidden costs, and the subtle mechanics of financial products can quietly shape the entire outcome of your portfolio. When most people think about investing, they imagine simple actions: buy low, sell high, and repeat until rich. Yet, in the real world, even the smartest strategies can be undermined by forces that are invisible to the untrained eye. One such force, perhaps one of the most misunderstood, is the silent erosion that takes place within the very structure of investment instruments, particularly exchange-traded funds, or ETFs. In recent years, ETFs have exploded in popularity. They promise diversification, liquidity, and access to markets that once seemed reserved for professionals. From commodities to currencies, from tech to bonds, ETFs now allow ordinary investors to hold slices of nearly every asset class on the planet. But with that accessibility comes a cost, one that isn't always easy to see on a balance sheet. To understand this, let's start with something called NAV erosion, the gradual reduction in the net asset value of certain funds over time. On the surface, an ETF may seem simple. It tracks an index or a basket of assets, offering investors exposure to that theme. But beneath that, the mechanics involve derivatives, roll costs, and sometimes complex structures that can eat away at returns. For instance, consider a fund designed to track short-term volatility. On paper, the idea seems sound. Volatility rises when markets fall, so a volatility-linked ETF should provide a hedge. Yet, over time, these instruments tend to decay in value, even if volatility doesn't fall dramatically. That's because of the way they're constructed, using futures contracts that must be rolled over as they expire. Each roll often comes at a cost, as the fund sells cheaper contracts and buys more expensive ones to maintain exposure. This rolling process is like running up a financial down escalator. You must keep moving just to stay in place. The result? Over the long term, the ETF's NAV erodes, even when the underlying index looks relatively stable. It's not that the investment manager is doing anything wrong, it's simply a structural consequence of how the instrument functions. Many investors fail to see this erosion because they only focus on price charts or short-term movements. But professional investors, the ones who truly understand what's going on, pay close attention to the yield-to-cost relationship. Yield, after all, isn't just about how much you earn. It's also about how much value you retain after hidden losses have done their quiet work. To illustrate this, imagine two different investors. The first holds a simple equity index fund, something like an S&P 500 tracker. The second holds a complex leveraged ETF that promises double or even triple the returns of the same index. At first glance, the leveraged product looks more exciting. After all, it amplifies gains. But what many people forget is that leverage also amplifies the internal costs and the volatility decay effect. Over time, even if the underlying index rises modestly, the leveraged ETF can significantly underperform due to the daily compounding of returns and losses. That's why serious investors often say, complexity comes at a price. This isn't just theory, it's something that plays out in real portfolios every single day. Some funds appear profitable for months, only to slowly bleed value due to these structural inefficiencies. Understanding that erosion, and knowing when it matters, separates those who invest intelligently from those who simply gamble in the dark. And that's exactly what this discussion aims to unravel: how modern investment vehicles, while powerful, carry within them hidden mechanisms that quietly shape outcomes. When investors talk about returns, they usually mean nominal returns, the number printed on their brokerage statement. But, the more insightful measure is realized value, what actually ends up in your pocket after expenses, slippage, and NAV decay. This distinction might sound subtle, but in practice, it's enormous. Take, for example, an ETF designed to replicate the performance of crude oil prices. At first glance, you'd assume that if oil prices rise 20%, your ETF should also rise about 20%. But in reality, that's rarely the case. These ETFs don't hold physical barrels of oil. They hold futures contracts, financial promises to buy or sell oil at a future date. As each contract nears expiration, the ETF must sell it and buy another, usually at a higher price due to what's called contango. This constant rolling forward means the fund loses a small amount with each transition. That loss accumulates, eroding value over time, even when oil prices are relatively stable. This is NAV erosion in its purest form: slow, invisible, yet undeniably powerful. The same applies to volatility ETFs, commodity trackers, and even some currency funds. Their performance doesn't just depend on the underlying asset's price, it's deeply affected by the structure of the fund itself. Now, you might ask, if this erosion is so significant, why do investors still buy these products? The answer is simple: accessibility and marketing. Financial institutions have become masters at designing products that sound appealing. Words like enhanced yield, double exposure, or smart beta sound like innovation, but they often mask complexity. For many investors, the excitement of potential high returns overshadows the subtle math that determines whether those returns are sustainable. And this isn't to say ETFs are bad, far from it. In fact, many ETFs are among the most efficient investment vehicles ever created. Low-cost index funds, for example, have helped millions of people build long-term wealth without the need for active management. The problem lies not in the tool itself, but in how it's used. When someone picks a hammer, it can build a house, or destroy one. The same tool, vastly different outcomes. That's the same logic that applies here. ETFs can be incredibly effective wealth-building instruments when used strategically, but they can also silently drain portfolios if misunderstood. To navigate this landscape, one must think like an engineer rather than a gambler. Not just the marketing. Let's revisit that concept of yield for a moment. Yield isn't simply the return printed on a prospectus, it's what remains after all underlying costs have been absorbed. A 10% yield on paper might only translate into a 5% real gain, once NAV erosion, management fees, and roll losses are accounted for. Professional investors know this well. They analyze not just the yield percentage, but the sustainability of that yield. Where does it come from? What structural risks exist beneath it? How is the yield generated, from genuine profit, or from financial engineering that might not last? That's why, in modern investing, understanding the story behind the number matters more than the number itself. In the world of high finance, many products are designed to look stable on the surface, even when they carry hidden volatility underneath. It's kind of like a calm lake that hides a powerful current below. On the chart, prices appear steady. In reality, the fund is constantly adjusting positions, absorbing transaction costs, and managing leverage. And over time, those little adjustments, each one seemingly insignificant, add up. This is where investors often fall into the trap of performance illusion. They see a fund that once delivered strong returns and just assume that trend will continue. But the hidden truth is that much of that performance was front-loaded, a product of favorable market conditions rather than sustainable structure. As markets shift, as volatility rises, as interest rates change, the weaknesses in these products become visible. Suddenly, that once reliable ETF starts losing value faster than expected, and by the time most investors notice, the damage is already done. What's even more fascinating is how this erosion interacts with human psychology. Investors tend to chase what has recently performed well, a phenomenon known as performance chasing. When an ETF delivers strong returns for a few months, it attracts more inflows, driving up demand. But, by the time the average investor joins in, the structural costs begin to weigh heavily, and performance fades. It's the classic cycle of excitement followed by disappointment, and it happens again and again. If there's one lesson the modern investor must internalize, it's this: returns are temporary, but structure is permanent. You can't control market movements, but you can control what kind of financial machinery you tie your money to. That's why sophisticated investors spend so much time analyzing the mechanics, not just the marketing pitch. They read prospectuses, study fund roll costs, and calculate the impact of compounding and leverage decay. Because in the long run, it's these small details that separate success from stagnation. So, when you hear phrases like double exposure, daily rebalancing, or enhanced yield, remember that each of these comes with trade-offs. There is no free lunch in finance. Every boost in potential return carries a hidden cost in complexity, volatility, or decay. The key isn't to avoid complexity entirely, it's to understand it deeply enough to decide when it serves you and when it doesn't. Because in the end, investing isn't just about chasing returns, it's about sustaining them. In every generation, investors rediscover the same truth, that risk and reward are not enemies, but twins born of the same parent. One cannot exist without the other. Every time the market offers an unusually high reward, it quietly hides a risk of equal or greater size behind it. And yet again and again, investors find themselves lured by the shimmer of extraordinary yield, convinced that this time, the risk is different, or that somehow, it no longer applies to them. In the world of high-yield ETFs and complex income products, this illusion takes on a particularly seductive form. Imagine a product that promises double-digit monthly returns, that pays you like a salary and requires none of the daily stress of trading. To most people, it sounds perfect. Income without effort, profit without volatility, a steady stream of cash in a chaotic world. But finance has never offered perfection. Every advantage comes with a compromise. Every comfort hides a cost. Yield, in essence, is simply a reflection of risk being transferred. When a fund offers a 12%, 20%, or even 40% annualized payout, it is not creating wealth from thin air. It is redistributing uncertainty. Somewhere inside that fund's structure, risk is being packaged, shifted, or delayed, but it never disappears. Understanding this principle is the foundation of real investing. Without it, even the most intelligent investor becomes a gambler dressed in professional language. To see this clearly, consider how these high-yield products work. Many of them use covered call strategies, selling call options on stocks they already own to generate additional income. When volatility is high, the premiums on those options can be lucrative. The fund collects those premiums and passes them on to investors as dividends. On the surface, it seems brilliant steady income in exchange for limiting some of the upside, but the hidden trade-off is that while the fund earns income from the calls, it sacrifices potential growth when the underlying stocks rally. Over time, this can cause the share price to stagnate, or even decline. It's a quiet erosion, not always obvious in the short term, but very real over the years. And this is why investors must learn to look beyond yield and examine total return, the sum of price movement and distributions. Because high yield can often mask poor total performance. A 15% annual dividend means little if the fund's price drops 20%. This distinction between investments all brave, all distinction, all be nachtingeweisen, Obessing does not in their income and outcome, or it defines whether an investor truly understands what they own. Another layer of misunderstanding arises from the growing obsession with dividend frequency. Monthly payments used to be a luxury. Now, investors demand weekly or even daily distributions. The psychology is understandable. People like regular income. It feels tangible, reliable, and reassuring. But from a structural standpoint, the frequency of payments adds operational complexity and potential cost. The more often a fund needs to distribute income, the more it must adjust its internal holdings. And every adjustment comes with trading costs, spreads, and in some cases, tax inefficiencies. Ironically, the pursuit of smoother income can create rougher long-term returns. That doesn't mean these products are inherently bad. It just means they are tools designed for specific purposes. Like a scalpel, they can perform delicate work in the hands of a skilled professional, or cause damage if used carelessly. The tragedy is that most retail investors never read the underlying documentation. They see the yield percentage, maybe the recent chart, and nothing more. Prospectuses, methodology notes, and risk statements are often ignored, even though they reveal everything that matters. Inside those pages lies the truth about what drives the yield, the structure, the derivatives used, the rebalancing frequency, and the leverage factor. Ignoring those details is like flying a plane without knowing where the fuel gauge is. And this is where investor psychology once again plays its timeless tricks. The human brain craves certainty. It would rather accept a flawed promise than face an open question. When markets are calm, people chase growth. When markets turn uncertain, they chase income. It's the same fear of loss, just expressed differently. In 2020 and 2021, investors flocked to speculative tech stocks, chasing explosive upside. By 2023, many of those same investors shifted to high-yield ETFs, chasing stable income instead. But in both cases, the underlying behavior was identical: emotional reaction dressed as strategy. Real investing requires something different. It demands emotional discipline, the ability to stay rational when others are either euphoric or afraid. To maintain that discipline, every investor must know their purpose. Ask yourself, why am I investing? Is it for long-term growth, for consistent income, for capital preservation, or for a blend of all three? Each goal demands a different approach. The person seeking to replace a paycheck with monthly dividends must think differently from the one building generational wealth. That's why the first step in portfolio design isn't stock selection, it's self-assessment. A young investor with decades ahead might tolerate volatility in exchange for growth. For them, traditional dividend growth ETFs, those yielding 3 to 5% with steady annual increases, offer compounding potential without sacrificing future upside. An older investor, closer to retirement, may prioritize income stability. For them, a modest allocation to covered call ETFs can provide cash flow, but it should never dominate the portfolio. 20% perhaps is the upper limit, enough to enhance income without exposing the entire nest egg to market erosion. Because when you go all in on any single strategy, you are no longer investing, you are betting. True diversification doesn't mean owning many things, it means owning things that behave differently. A portfolio of 5 high-yield ETFs is not diversified if they all depend on the same market conditions. The illusion of variety can be more dangerous than concentration itself. That's why sophisticated investors study correlation, not just count holdings. They look at how different assets move relative to one another in various market environments. When one position zigs while another zags, risk begins to balance itself out. But when every position dances to the same tune, the entire portfolio becomes one large bet disguised as many small ones. This concept extends beyond ETFs. Even in traditional dividend investing, correlation matters. A portfolio of consumer staples, telecoms, and utilities might seem balanced until inflation rises and interest rates spike, pushing all three sectors downward together. Diversification, in essence, is about preparing for what you cannot predict. And yet, investors often abandon it the moment a new product promises extraordinary yield. The logic seems irresistible. If one high-yield ETF pays 12%, why not buy 3 of them and live off 36%? But of course, that's not how math, or markets, work. Each additional product simply compounds the same risk, dressed in slightly different branding. It's a modern echo of the oldest truth in finance: the higher the yield, the higher the risk. But the risk doesn't always show up immediately. Sometimes it hides for years, accumulating quietly like pressure beneath the surface of a fault line. And when it releases, it's sudden and unforgiving. History is filled with such moments. In every cycle, investors believe they've found a safe way to harvest high returns. In the 1980s, it was junk bonds. In the 2000s, it was mortgage-backed securities. In recent years, it's been complex derivative ETFs that promise the impossible: high yield, low risk, and infinite liquidity. Each era ends the same way, with a realization that complexity doesn't eliminate risk. It merely delays its recognition. So, what does a responsible strategy look like in this environment? Well, it begins with simplicity. Start with core holdings that represent broad market exposure, like low-cost index funds or dividend growth ETFs that capture long-term compounding. Around that core, you want to build purposeful satellites, smaller allocations to income-focused products, maybe a few covered call ETFs or bond funds, but always with clear awareness of their mechanics. Never buy yield for its own sake. Instead, buy reliability of income and really understand what makes it reliable. Reliability doesn't come from high numbers, It comes from sustainability. An ETF paying 5% for 30 years is far superior to one paying 25% for 2. Sustainability is the quiet power that separates wealth builders from wealth chasers. To achieve it, investors must learn patience. The compounding effect of steady returns is, invisible at first but pretty much unstoppable over time. A small, consistent yield reinvested faithfully can outgrow the flashiest high-yield product. It's mathematics, not magic. And yet, this simple truth remains the hardest to accept because it just lacks excitement. The allure of fast income, of visible results, appeals to our desire for immediacy. But investing isn't entertainment, it's architecture. You don't build a skyscraper overnight. You lay one floor at a time, making sure each foundation can bear the weight of what comes next. Another critical principle is tax awareness. Many investors forget that dividends, especially from high-yield ETFs, are taxable as income in most jurisdictions. A 12% yield taxed at 25% effectively becomes 9%. In contrast, capital appreciation from a dividend growth ETF might benefit from lower capital gains tax rates or even tax deferral. The lesson is clear: never compare yields in isolation. Always compare after-tax, after-cost total returns. Even more important is the concept of return of capital, which, honestly, is a subtle term that often misleads investors. Some high-yield funds distribute not just profits, but also parts of the investor's original principal, labeling it as income. On paper, it looks like a generous dividend. In reality, though, it's simply returning your own money to you, while the fund's value declines quietly in the background. This practice isn't fraudulent, it's disclosed in fund documents, but it really reinforces the need to read beyond marketing headlines. What looks like a 20% yield might be a 10% genuine return, and a 10% return of your own capital. If you spend all of it, you're slowly liquidating your portfolio without even realizing it. But if you reinvest a portion of that income, you can offset the erosion and maintain long-term balance. That's the key difference between using these instruments intelligently and, misusing them completely. In the end, every investor must learn the art of self-control. The market rewards consistency, not impulsiveness. The investors who thrive are those who can resist the emotional highs of greed and the emotional lows of fear. When yields soar, stay skeptical. When prices fall, stay calm. The true measure of an investor is not how much they earn when markets rise, but how little they lose when they fall. That's why portfolio construction is as much about psychology as it is about mathematics. A portfolio you can't emotionally tolerate is a portfolio you'll abandon at the worst possible moment. If a 20% drop would make you panic, then you're overexposed. Reduce risk until you can sleep peacefully. The best strategy is the one you can actually stick with. Looking forward, the evolution of financial technology will bring even more sophisticated products, tokenized assets, algorithmic ETFs, daily dividend distributions. These are not distant ideas, they are already emerging, but sophistication doesn't equal safety. Each innovation adds another layer between investor and asset, and with each layer, transparency becomes more difficult to maintain. The future investor will need to be more informed than ever. Education will be the ultimate edge. Because in a marketplace, overflowing with complex options, the simplest truths will remain the most powerful. Understand what you own. Diversify intelligently. Reinvest consistently. Avoid emotional decisions. Every financial crash, every bubble, every wave of euphoria and despair has been built on forgetting these truths. But those who remember them, who treat investing not as speculation but as stewardship, will always come out ahead. In the end, the most valuable investment isn't in any stock or ETF. It's in knowledge, the kind that allows you to see through illusions, interpret risk correctly, and make decisions grounded in understanding rather than emotion. Because when the noise fades and the markets calm, what remains isn't the glamour of yield. It's the quiet strength of wisdom, discipline, and patience, and that is where true wealth begins.